David Burrows was on Market Call October 25th of last year. His top picks are up a combined 16.33%. There is one fly in your top pick ointment. As we can see, it's Intel, down about 8.4%. You don't own it anymore.
No.
What happened?
Look, a year ago, large cap tech really was leading this market, led by companies like IBM and Intel. In the last year, semiconductors have become a notable laggard. In fact, that's one of the things that concerns us about the current market is semiconductors are behaving so poorly. And, you know, unfortunately, Intel has a big impact from the PC market. And as we've seen recently, PC data is very, very weak. So despite the fact, great balance sheet, great cash flow, it's in the wrong neighborhood. And I think that there's better opportunities.
That neighborhood that you want to be in, I can imagine, will be more mobile than desktop.
More mobile than desktop, and frankly, we have not a lot of tech right now in the portfolio. This is the time of year it should be performing well, and large cap tech is performing poorly as a group.
Time now for the top picks.
Top Picks is brought to you by Questrade, where you can trade stocks for $4.95.
Time now for the top picks from David Burrows of Barometer. And as we discussed a little bit earlier, you're getting a little more keen on gold these days. Why Yamana over one of the other gold diggers?
Okay. So first of all, gold, very clear, central banks are going to continue to monetize. So this is a big beneficiary. Stocks are now outperforming the metal. That's a second key point to get us there. The knock against gold producers is that they very rarely meet expectations. They have cost overruns. They don't get their production up to speed. Yamana is the only one of the really big gold producers that hasn't had any disappointment in the ramping up of their mines. So they take their production from 1,000,002 ounces to 1,000,007 by 2014. They'll generate positive cash flow all the way through. It pays a dividend. The dividend is only based on next year's earnings, about 16–17% of earnings. So you can see dividend increase. It's got all the things I look for: positive cash flow, dividend growth, exposure to a leadership group, and it's one of the winners in the group.
Current dividend 1.4%, 6.5 cents. At what point do you think that they would turn the knob and raise it?
Well, I think that as you see their production ramp up over the next year and as their cash flow grows, you will see them raise dividends.
The stock's already up about 25% over the course of the last 52 weeks. And I know you're not a target price kind of guy, but tell me about looking ahead, considering I'm seeing that the earnings revisions, estimates anyway, are coming down and they're not going up.
Yeah. If you put up a chart, you're going to see that it's recently broken out of a pretty good base technically. So I think really it's more the beginning of a move. All of the gold stocks had a little check back this week. They've hung in very well, and I'd expect this move to resume. So I think it looks very attractive. I think you could see, you know, solid returns over the next 6 months.
Well, the street's consensus is it'll flirt with $22 in the next year, which is about a 16% return from where it is right now.
Look, there's only so many sectors right now that are performing well. You want to take advantage of those that absolutely benefit from monetization.
Top pick number 2, Granite Real Estate, GRT on the TSX. We had a guest just yesterday tell us that he liked this one.
Well, we've used this one before. This is probably the second biggest sector weight that we have in real estate investment trusts. And they absolutely benefit from lower borrowing costs as a group. When you look at Granite, there are lots of near-term catalysts. It'll become a REIT in January if all things go according to plan. Once it becomes a REIT, they will be paying out less than 75% of their cash flow, which is a positive. They are under-levered. They have almost no debt, so they have a very, very strong balance sheet. And they're a long way, I think, down the road to renegotiating leases that they have with Magna, who are their biggest tenant.
Right. So if only 75%, if it's a 75% payout ratio, that gives them a lot more cash, walking around money. Is this the kind of company that would be beneficial to see it buy up a lot of additional land?
Well, I think that they're looking, but I think that they will be very disciplined in what they do. They have a balance sheet that will allow them to take advantage of opportunities. I don't think that they're in a hurry to do it. But at a 5.6, 5.7% yield and a low payout, that's what I'm looking for. Those that have the ability to raise what they're paying us.
What about stock price appreciation? While we clip that 5.6%, do we also see the equity rise?
We know that over the last 25 years, the single best camp to focus in were those that paid a sustainable dividend, but that grows over time. You don't want the highest yield, you want one that will grow. This company's in the perfect situation for that.
Abbott Laboratories, meantime, top pick number 3, paying out that 51 cents today. 2.9% dividend yield. Does that rise anytime soon?
Well, we've been looking at companies with near-term catalysts. Kraft was one we talked about a little while ago. Abbott is going down the path to splitting into two pieces, the pharma business, and the other business would be nutritional products and devices. The pharma business has a higher than industry growth rate, and you would expect to get probably a 3.5% to 4% yield on the stock. If you take the second piece, which is nutrition and devices, it has a higher growth rate. And so that will be the grower of the two pieces. Between the two, it's probably worth $85 or $90, and you get a yield along the way. The patent cliff for all of these companies is really here, and it's priced into these things. And the pharma stocks are among the best performing sector in the market right now because of its predictability.
38% increase over the course of the last year, but you can't call that a widows and orphans stock, even though it's got its beta is substantially less than the broader S&P 500.
If you think about how often you get asked about healthcare stocks on the show, it tells you how many people own healthcare. Healthcare has just broken out of a 13-year base, made new highs for the first time over the last year, and this is a group that is way out of favor, but has all the characteristics people are looking for: predictability, cash flow, and dividend yield. Fully
valued at this stage in the game, according to the street, though. So this is really about the dividend more than anything else?
I think that what happens is people have a tendency to look in the rearview mirror and say, relative to the last 10 years, valuations are expensive. This group, I think, is in the process of going into a revaluation.
David, as always, great having you with us. Thanks for coming back.
Thanks for having me, Michael.
David Burrows has been our guest, president of Barometer Capital Management. That's it for this edition of Market Call. The encore presentation airs Tuesdays through Fridays, 8 p.m. Eastern, 5 o'clock Pacific. And join Mark Bunting live Monday through Friday, 6 p.m. Eastern for Market Call tonight. The full 1-hour show repeats 11 p.m. Eastern, 8 o'clock Pacific. As always, please consult a qualified financial advisor before making any investment decisions. I'm Michael Hainsworth. You can follow me on Twitter for the guest picks, breaking news, and behind the scenes here at BNN. Thanks for joining us. BNN.ca will have the replay for you shortly. Thanks for joining us. Hope to have you with us next time.